So what does it take to make investing a habit? What if you could just turn it on autopilot and never forget to invest? That's what so many of us need to do in our lives, but it becomes difficult. We have all kinds of reasons why maybe we shouldn't save or maybe we shouldn't invest. Maybe we have some pressing financial bills. Maybe we have some debts that we have to take care of. And so we constantly delay saving and investing in our lives. And this is a problem. It's a problem that we see. I saw a recent headline that came out from a study that showed that 7 out of 10, this was a small study, but still I think it's pretty indicative of where Americans are in general with their finances, that 7 out of 10 Americans, when surveyed, were living paycheck to paycheck. And that's an enormous number. 70% of Americans living paycheck to paycheck. And, it doesn't have to be that way. You may be in that situation and you may say, well, yes, it does. But the truth is, it doesn't have to be that way. You really can break free, but it's going to take habits, right? I think about even in my own life, as you get older, you learn that you have to improve your eating habits, right? So whenever you're young, you may feel like, well, I can eat, anything I want. I can drink caffeine, all the way late at night. I can drink coffee in the middle, with dinner, or maybe I can even, have lots of sugar and candy and soda and all of this, donuts. But at some point, you realize, wait a minute, that's just kind of destroying my body, right? And so you realize I've got to change this. And sometimes it's just literally habits. So for a long time, I drank soda and I drank Pepsi. I was a big Pepsi fan. And so I would probably drink, a few a day. And this was, years ago. And slowly but surely, I weaned myself off of that habit because I said, I don't want this in my body. I don't want to do this every single day, right? I might have a Pepsi occasionally, but not all the time, right? And there was other things too, just little things here and there. And I started to make changes in my habits about what I was eating. Now, whenever you hear about eating, you often hear people will say, well, if you want to be healthy, what do you need to do? Well, you need to eat plenty of fruits and vegetables, right? Every time they say this on TV or on the news, you're like, I know this, right? You got to choose foods that are low in added sugar. Okay, we know this. Avoid saturated fats, avoid too much sodium, pick whole grains, focus upon lean sources of protein, exercise, right? So we know all of the habits that we need to get into if we want to be healthy. Well, the day that will transform your financial life is the day that you commit to make saving and investing money a personal habit. This is why I think comparing it to health is so important, because we can make changes in our health. And when we're young, we often think, well, I can make these changes later, right? Because I'm healthy and I'm young and it doesn't seem to affect me. But as you get older, your body, kind of starts to let you know, hey, we can't eat like this much anymore. It's beginning to hurt your body. And so we have something in us that tells us that. Well, when it comes to investing, we need to have similar kinds of alarm bells that go off that say, hey, you cannot depend upon the government, friends, or family forever. You're going to have to invest. You're going to have to save. And that's why thinking about, good eating habits and making good eating and healthy habits, a part of your life is very similar to saving and investing. The answer to financial wisdom is no different. Here's the solution. Here's the big secret for financial success. It's simply this: spend less than you earn and invest the difference in high quality assets. There's the secret, right? So what's the secret to good health? Eat foods that are, in the closest state to nature as possible, exercise, and don't eat a bunch of artificial junk, right? So we all kind of know how to get healthy. Now, what about finances? How do you get there? How do you improve? Here it is. Spend less than you earn and invest the difference in high quality assets. And that's the secret for financial success, regardless of your income level. You may never be a billionaire or maybe even a multimillionaire. And that's okay, because believe me, that's not what life is about. Life is about love for our Creator. It's about love for our fellow man as ourselves. It may be surprising, but wise financial stewardship is a form of self-love and love for others who depend upon us. My point is quite simply how we use and harness the financial resources in our lives. It matters. And that's why we created our 5 levels of financial freedom many years ago, to help people from all walks of life take control of their finances and begin a journey of self-discipline towards financial freedom. But in the 21st century, becoming an investor has never been simpler. You have a myriad of investing apps and platforms that are available with any internet-connected device. I mean, today you can buy fractional shares of stocks on many platforms like Robinhood. You can buy cryptocurrencies with the click of a mouse. You can buy hard assets with a phone call or online. The barriers to investing in real estate today are also relatively low when compared to times past. Starting your own business has never been cheaper or more accessible to people than it is today. Put simply, there are so many opportunities for every individual, regardless of their current circumstances. 3 major financial habits that will change your life are to give regularly, save regularly, and to invest regularly. And when we think about all of these rules, when it comes to giving regularly, well, we have talked about that before. We've talked about it on several podcasts in the past. We have one podcast entitled The Blueprint for True Wealth. We also have another podcast we did not too long ago called Giving on Purpose. So that's a huge financial rule. Another rule is to save, right? To save at least 15% of your income every month and to save 6 months of income and then have that as your emergency reserve or your opportunity pool of capital. So you can learn all about giving and saving in our 5 levels of financial freedom. But today, on today's podcast, what I want to focus on is this habit of investing. Now, I have often shared one of my favorite and most simple definitions of investing that comes from Gerald Loeb in his book, The Battle for Investment Survival. Gerald Loeb was a very interesting investor who lived through the Great Depression, and he viewed investing as a battlefield, almost like a war. And his definition of investing has always stuck with me, and here it is. He says, storing present purchasing power for use in the future is investing. Very simple, it's not rocket science here. We're simply taking the current purchasing power that we have. We can go to the store right now and buy, a loaf of bread or a gallon of milk. Well, that's what we can buy right now. But if you leave that money in the bank and you don't invest it, you'll discover that you won't be able to buy that same, loaf of bread or that same gallon of milk with the same dollars because of inflation, right? Your dollar value is eroding and the price of things are going up. It's really kind of a function of the same thing. So when it comes to investing, what you're doing is you're taking current purchasing power and you are storing it away for use in the future so your future self can use it. So what you're doing is you're putting your money to work. And if you don't put your money to work, then the effects of inflation are going to really rob you of your purchasing power over time. And that should not be acceptable to you, right? Just as the same way with your health, right? If you're eating poorly and then you're hurting your health and the doctor's like, look, you need to do something. Well, that is a similar situation to many people who, are faced with a paycheck to paycheck lifestyle and they're not saving, they're not investing, and therefore the inflation is literally their worst enemy here, right? So when we talk about investing, we want to do it every single month. We want to do it regularly, right? Now, before you invest, of course, you want to look at our 5 levels of financial freedom. Just go to followthemoney.com/5 levels. And you want to make sure that you've saved up some money first, right? Good savers make better investors. Too many people jump ahead of the game and they try to start investing before they have even saved any money. I can tell you from personal experience, that's the wrong way to do it. Don't put the cart before the horse. Make sure you save at least 6 months of your present income. Keep it tucked away at all times. And, you can get there by saving 15% of your income. If you can't save that, start saving 1%, 2%, however much you can begin to save and slowly get to that 15% number. And then once you have saved, by doing that, once you have saved 6 months of your income, then you can begin to take that same savings that you're using every month and then start putting it into a new bucket called investing. And you will then continue to start investing. So once you have your 6 months of savings saved up, right? If you earn $30,000 a year, you want $15,000 in savings. You need that money for emergencies. You need that money for an opportunity pool of capital. You don't want to have to use Visa or MasterCard every time there's an issue and they get further and further in debt. So what you want to do is you want to have access to that 6 months of liquid savings. Make that your priority. But once you have that 6 months of savings, then you begin to become an investor. And that's the exciting part that many of us need to get to if we're not already. The only time you would stop investing from that point is if you have to use your emergency savings. So if you have to have a flat tire or you need to replace, God forbid, you need to replace the roof on your home or something like that. Well, when that happens, then you would use your emergency capital to do that. And then you would fill that back up. That's the only time that you would really stop investing. Then you would resume investing once your savings was back to your 6 months of income. Now, the way we do this is we prefer dollar cost averaging, right? So we just regularly invest into high quality assets on a regular basis. And the regular is the key. This is a habit, right? What do healthy people have in common? They what? They eat fruits and vegetables. We know this, don't we? They exercise. And what else do? They don't eat a bunch of junk, right? They don't eat a bunch of processed food. That's what healthy people do. What they also, they do many other things as well. What about people who write? I remember, I'll tell you a story. Whenever I was in college, I had a writing professor, and he was one that actually really inspired me to write my first book. And I went to him after class one day, and he was an accomplished author. He was a best-selling author. He was actually in the movie Cars. He was one of the voices that was used in that Pixar movie. But he also wrote a really compelling book on the topic of Route 66, really neat book. And he had traveled the road, and it was just really neat. Well, anyway, I went to him after class one day and I said, I really want to break into the field of writing. I was young and I wanted some tips. And he said, how much do you write? And I said, well, I like to write, but I don't write every day. And he said, well, you're not a writer. And it kind of stunned me. And this was really all that he ever gave me, but it still stuck with me. It was so powerful. He said, writers write. And that was the whole extent of his advice to me. But that advice still rings in my ears because it makes me realize that I'm not a writer if I don't write. We are what we do. We are the sum total of our decisions and of our habits. So therefore, if I call myself a writer, but I don't write, am I a writer? No, writers write, right? That's what makes a writer. What do healthy people do? Healthy people eat healthy, right? So what do people who are smart investors do? They invest. So if you say, I'm an investor, but you don't regularly invest, well, are you really an investor, right? Investors invest, right? That's what they do. So you've got to get to a place where you invest. Now, whenever you're thinking about investing, the way I do it is I use a method, very popular method called dollar cost averaging. So we also refer to it as DCA, just the initials. That's the act of investing all of your available money over time. So as opposed to lump sum investing, that's the act of investing where you put all of your available money in at once, right? To me, dollar cost averaging makes more sense because over time, you're able to buy more shares when the price goes down and you buy fewer shares when the price goes up, right? So it helps your overall cost basis over time. In fact, Warren Buffett has a quote that he said, if you like spending 6 to 8 hours per week working on investments, then do it. If you don't, he said, then dollar cost average into index funds. I really agree with Warren Buffett here. Most people may not have the time to properly research stocks, individual stocks, or other types of assets. And therefore, they really need to be careful. And in the case of stocks, you can actually buy an index fund, say like SPY, which covers the entire S&P 500. Then you own 500 of the best companies, in the United States, or maybe you buy the NASDAQ 100, where you own the top 100 companies in the NASDAQ Composite Index. You can just get exposure to an index fund. Maybe you have no idea what stock to buy. That's okay. Then you can just simply invest in an index fund, and the index fund will then deliver you those gains over time, and you won't have to do all the research that a individual stock investor would do. So don't let your lack of knowledge hold you up either. So many people will make excuses when it comes to their health, when it comes to their even to their financial life, because maybe they don't know something, and so therefore, I can't do it. No, there's still lots of tools available to you, no matter where you are, no matter what your circumstances are. The key is to invest a little bit every single month, right? And there's so many different places that you can invest, right? You can certainly leave your money in cash, but you're going to get all the eroding factors of inflation just going to erode that money over time. You can also invest in real estate. You can invest in commodities and hard assets. You can invest in, digital assets. You can invest, of course, in stocks and ETFs, your own business. Right? There's so many different places for you to invest. And to me, it's extremely important that you just begin. You just get started. Let me leave you with a few comments here before we close out this segment. The first comment I want to make is that the longer that you invest, the lower your overall risk. So if you begin to buy, say, shares of a high quality company, say, like Walmart or Amazon or one of these, very large, high quality companies, the longer that you invest, the lower your overall risk, because over time, all things being equal, ceteris paribus, as they say in economics, well, you're going to see that the price is going to rise up to the right because these companies are making money and they are growing. So that's going to lead to their higher share price. Also, you need to expect some down quarters and down years in your pursuit pursuit of strong long-term gains. So don't be discouraged if you begin to dollar cost average in to your investments, like say the stock market, and you begin to see the price come down a little bit. Don't be alarmed. You're going to have some of that over time. If you're looking for strong long-term gains, keep buying when the price comes down for your investment. That way you can improve your cost basis. If you have a 10 or 20 year time horizon, then it's not going to matter about the squiggly lines on the chart right this second today. And finally, my final piece of advice here is to, once you start investing, don't stop, right? Put it on autopilot with your brokerage account. You can automatically set it up to go right into your favorite stocks. Maybe you're buying an index fund. Maybe you're buying certain stocks. Do your research and then get started, and don't stop investing. Whatever you do, keep it on autopilot. And I can make one promise to you in conclusion, is that if you will commit to making a habit of investing in high quality assets regularly, your future self is going to be very, very grateful. Don't let your future self down, and don't let those who depend upon you down. Take time to create those healthy habits in your financial life that will pay your future self handsome dividends.